Yesterday, seeing the biggest drop in the cash trade in 5 years. NASDAQ futures down 2.8%. Russell 2000 futures, after the index has gone into an official bear market, down 22% from its high, off another 4%. So there will be blood, as JP Morgan's Bruce Kasman said in his note today. You can see RBC Capital Markets ringing the bell at the New York Stock Exchange today, celebrating a 31st anniversary of some hockey charity or something. Microsoft down at the NASDAQ celebrating their 50th anniversary, in a pretty scary reminder that I am older than Microsoft, Katie. So that doesn't matter today. All that matters is the sell-off we're seeing and in stocks and the buying that we're seeing in bonds.
Absolutely. Let's talk about the stocks first, because I want to take a look at the likes of Apple and Tesla, Alibaba, all linked to China. Remember, China added a 34% tariffs on all American imports starting on April 10th. That was announced earlier today. We just got a response from President Donald Trump on Truth Social, posting that China played it wrong. They panicked. So not exactly a free-flowing negotiation just yet. You can see that those sell-offs that we saw materialize yesterday gaining steam today. Apple down 3%, Tesla not too far off, Alibaba down nearly 9%, Matt Miller.
All right, we are watching other sectors, including retailers. We see continued slide from Nike today after the company was decimated again yesterday, now down 4%. Energy also, as we see the underlying oil price absolutely crater, we see the energy producers drop as well. We're looking at NYMEX crude, by the way, under $62 a barrel right now, so Occidental is off. And then banks continue to fall. JP Morgan Chase is one here, but you can look really across the KBX and see that they're all down. JP Morgan off 6%, all deep in the red following that Chinese retaliation news. We're back with BlackRock's Rick Reeder. And Rick, let's dive into this trade war, which is kicking off. I guess the Trump administration put massive tariffs on China. China is striking back with massive tariffs on the U.S. How does this play out for our economy?
Listen, I mean, in the near term, and similar to what we talked about, there's a lot of discussion about recession. And, the way we define recession is interesting. You get a couple of quarters of negative growth. What I actually think is happening is you could have a downturn because of people sitting on their hands. That could be pretty intense over the short term. I don't think it's, quite frankly, I don't think the timing is at 2 quarters or 3 quarters or 1 quarter of softness. It's the intensity of how much do people sit on their hands for a while. So, listen, I think it's going to be, we're going to have a softer period. I think you have to build that into your asset allocation, how you run risk, because we're not going to know, at least for a few weeks, what the ultimate outcome is. When will corporate CEOs start to do more in CapEx, R&D, M&A? Well, my sense is it's going to take a few weeks for that to play out. But I think you have to build in any portfolio. There's going to be a soft patch.
All right, so you're saying a softer period, a soft patch. I want to go to a note that came out this morning from George Saravelos over at Deutsche Bank. He wrote that the market is doing one thing, pricing in a global recession. Rick, it sounds like you don't quite see that yet.
So, no, I see some significant slowdown in the near term. Like I say, whatever we call it or whatever we term it, I think you got to manage your risk. I talked about it last week, the week before. I think you got to pull back on risks that you take within portfolios. And I think you're going to see some tangible slowdown in terms of, what orders go through, how do companies think about their inventory development, how do they think about what cost of goods sold is going to be, what does it mean for margin, do you have to start to make some inventory adjustments, CapEx, people adjustments. So, listen, I think your portfolio has to reflect that this is going to be a weak period. And,
right.
The question of defining the durability of that, I'll say one thing that's very different when people think about spending. CapEx you put in place for 5 years, 10 years, sentiment can change amazingly quickly. And so we're in this period where sentiment now is going to be really tough. That can change. And so I think you got to think about, how do you position, what are the conditions that you'd operate in where sentiment, my sense is sentiment will change quite a bit, whether that's a month from now, 2 months from now, or 6 months from now. Is going to be the key for markets.
Well, Rick, is that what you're doing? Because if I take a look at Bink, of course, that's your ETF. I see a 9.5% allocation to investment-grade corporates. Then I see a nearly 38% allocation to high yield, which certainly we've seen some cracks start to form in the corporate credit market. Should we see some of those come down in coming days?
So I think if you study it, which you do, I think you'll see those having come down. But I will say one thing about, the one thing about positioning around, the things you do a week before, 2 weeks before tend to be your best, how you manage a portfolio. Increasing some of your interest rate exposure, bringing down some of the lower quality parts of your portfolio is definitely what we've been doing. And by the way, if you think about single B high yield in the U.S., double B in Europe and the U.S., that credit conditions should be okay. Managing that and putting some hedges around it, including some interest rate. You can look at performance of how a portfolio like this did versus the high yield market. That's why it holds up so well.
I look at all the enthusiasm that we had coming into this year, Rick, was about deregulation and tax cuts, right? And it doesn't seem like the M&A guys are seeing the kind of allowance that they were expecting. And then in terms of taxes, JP Morgan's Bruce Kasman says this tariff hit, a 22% all-around tariff on imported goods, represents the biggest tax hike the U.S. has seen since 1968. Even I wasn't born yet in 1968. That doesn't seem like it's great for animal spirits, especially when Republicans are also talking about actual tax increases.
Yeah, I was born before '68. So the one thing I will say, listen, I think I think I said this last week. I think the dynamic of we've gone from animal spirits to animals in hibernation, and that's where I think we are. I think it is literally just hold off and wait and see what all these things that play through. I think companies are going to have to make significant adjustments. If you're a multinational, how you think about your supply chain, how you think about your distribution function, how you think about assembly. Like, I think all those things are going to change, and that's why we're in this period that I think is like, it is, to make decisions to add a lot of beta or think about risk today. I just think you got to be conservative. I think, I think you got to hunker down for a bit of time here.
I was in a Bloomberg chat with some private equity companies yesterday, and their portfolio companies are not going to be able to relocate production into the U.S. and are going to have to essentially double prices. That just isn't going to work for so many manufacturers out there. Do you expect these tariffs to somehow go away?
So, Matt, the thing we were going through today that is fascinating. So there is a transition. So, it's all about elasticities and the reaction function. And so we were trying to think, well, what is nominal GDP? If you slow down real growth, do prices stay exceedingly high because you've got these tariffs? And so your nominal GDP stays high because you've got higher prices and higher inflation. My sense is that doesn't capture the elasticity around it, meaning what will happen is companies will have to reduce prices. You're seeing that in some of the retailers, more promotion, more couponing. So I think what will happen is companies, the first reaction function, I'm going to pass through price. Maybe I don't pass through all of it. I'll absorb some in a margin. I'll try and pass through some. My sense will be you won't be able to pass through that much, which will denigrate your ability to actually get that price, and you'll start to see prices come down. So I think what will happen is you'll see volumes come off, and then you'll start to see prices will have to come down, or you just won't sell the volume. You just won't move the inventory you need to move. And listen, there will be some. There's no question. There will be some manufacturing that will relocate. It just takes time.
Right.
There'll be some distribution chains that will change, no question about it, depending on how people respond. And so, companies are going to try and keep that margin up. I'll throw out one thing that's hugely important. They're going to move faster towards productivity, automation. How do you make your business more efficient in a bunch of different ways? And that's the next trade that I think you got to put on.
And I do want to point out we're keeping a close eye on Apple, down about 2.5%, actually falling below that $3 trillion threshold on market cap. So these superlatives coming in quickly. I do want to end by talking about treasuries, because clearly there has been an enormous bid into the bond market, Rick Reeder. You know that well. But you have seen some notes out there, some worries starting to form that if this really continues, this trade war, and this deepens and escalates, whatever word you want to use, that you could see international buyers of treasuries step back even more than they already have. We know that China's holdings have been going down. We know that Japan's holdings have been going down. But do you think that that's a chip that's potentially on the table here?
So, tough one. So, listen, I think that there's a series of timing things to all these things. You know, we've talked about, we love the front end of the yield curve. You're pricing in a lot of cuts today. We've been taking some of our duration further out the yield curve for a variety of reasons, what it means for notionals, et cetera. But I still think, and, you know, we talked about, we've added some interest rate exposure, been pretty significant. The front end now has got some, you know, how do you think about the front end? How much can the Fed go if inflation is this high? But anyway, holding interest rate risk makes sense. The longer term paradigm is incredibly important. Part of why policy has to bring the debt down, part of why spending has to come down is exactly like you say. We've relied on international purchases of our treasuries for so long, and those countries, forget whatever retaliation is, those countries have to fund their own domestic. If your own domestic economy is going to slow, you've got to fund your own, you've got to issue debt in your own domicile. And that is a big deal. So, yes, I think you have to be really sensitive to that. It's part of why we need to reduce spending in this country. We need to manage the debt stack in this country because it's too onerous.
All right. Rick, great having you on the program. Really appreciate you spending so much time with us. BlackRock's Rick Reeder, also the manager of Bink.
Yes,
an
yes.
ETF that Katie watches very closely.
Well, it's grown pretty mightily since its launching. But I do want to point out, I liked your question about animal spirits because they've been nowhere to be found. Rick said that this is animals in a hibernation sort of mode. Do you know what animals hibernate?
Bears.
Bears.
Yes. Very good point. All right. So hopefully they can stay away. But we're not far off of bear market territory, right? We're down, what, 15% now on the S&P from
Somewhere
the high.
close to that, yeah.
Getting very close to bear market territory in the NASDAQ. And, of course, we've seen it on the Russell 2000. Coming up, we're going to talk about pharma avoiding Trump tariffs, at least for now. We'll look at the sector and top calls next. This is Bloomberg.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by
this right here, we talk about this a lot. This is a very strong signal for a short, right? And you get in here just as it's cracking the 5-minute range. So that's typically a really nice short opportunity there. So good stuff. All right, yeah. So here it is. I am going to stop out on Baba. I don't think it's, again, it's just not worth holding through this pullback here. So we will take
NVIDIA
everything
or
off.
Baba?
I'm sorry, NVIDIA. I have Baba on my mind
Okay.
here. Yeah,
Sure.
NVIDIA. No, NVIDIA.
Don't get out of the wrong thing.
Right. Don't hit cover and then go long on something else, right? Because if you don't have
Yeah.
shit, I think it goes long or something. Done that before.
Yeah.
Oh man. All right, so there is our NVIDIA trade. Again, just to kind of show you this, because I know you're going to see this a lot from me here, is at the market open, we get the pop-up, we get the breakthrough candle, is what I call it, right? This is a breakthrough candle here on the 1 minute. The pullback, and the breakthrough meaning breaking through the VWAP, right? It's VWAP here. You get the pullback to the VWAP. Once you get the confirmation that we're going to sell off, it's usually where I go long, stop loss above the VWAP, right? You got to give this enough room. And when NVIDIA, Tesla, Apple, and these very high volatile stocks, you even give it a little bit more room. But more than room, what I like to see is, I'm not concerned with this going up. I'm concerned if the candle closes above the VWAP. I'm more concerned that, okay, this might be, setting a new trend above the VWAP. But if you look at it here, both times I was looking at this closely, it did not close above the VWAP. So I do.
Head of European Pharmaceutical Research over at Barclays. Emily, it's great to speak with you again. And just set the scene for us. Any supply chain in any sector is going to be difficult to untangle from how globalized they actually are. But that feels especially dramatic when you think about the pharma industry.
Yeah, and I think what is just such a sweeping change for us looking at pharma on the investment side is just that, as President Trump said, unprecedented territory. Pharma has been essentially immune from tariffs due to a WTO agreement from 1994. So it's just something that we have never even thought we'd ever have to consider. And now, obviously, it sounds like this is coming down the road. We're trying to do the analysis and have sought guidance from all of our companies. But, we're still at very sort of high level thinking about the impacts as it's so difficult to quantify.
How hard is it? I mean, I know that we have some workers coming back to the Health and Human Services. Maybe the FDA doesn't lose nearly as much staff as we feared, but it's still going to be a slimmed down workforce. How hard does that make it for drug companies to get things through and to get new advancements out to the public that needs them?
Yeah, that is a super salient point. And to be honest, for me personally, that's what I'm more concerned about impacting the space rather than tariffs. Pharma products are still going to get made. These companies have very, very high gross margins, so they can absorb some cost increases. However, this is totally unprecedented at FDA. High level people at the organization that investors know about have left in the last week. Will this delay drug approvals? To be honest, we just do not know.
And I want to talk a little bit about specific companies. Novo Nordisk obviously is in your coverage universe. Novo having a really difficult start to the year, down 28%. And you think about Novo with its blockbuster obesity drugs, its biggest market is the U.S. I mean, when you think about the global impact of any specific sector tariffs here, I have to imagine that Novo could be in for more pain, Emily.
Yeah, and it certainly has been a painful period for Novo shares. And I think, it is getting sort of isolated as a potential tariff loser, if you will, given we know the supply chain because it's really centered on one drug. They make the raw semaglutide mostly in Denmark, although the filling and finishing is done elsewhere. And then, of course, Greenland, which is part of Denmark, seems to be in the headlines. However, what we're really looking for with Novo is, will obesity prescriptions start to rebound after the phenomenon of compounding, what Hims and Hers is doing in the U.S., is set to expire at the end of May? So that could be what we're all looking for as a potential turning point.
In your coverage universe, Emily, how much production is moving back to the U.S.? How many companies that you cover are saying, all right, in order to avoid tariffs, I'm going to bring all my drug production back to the United States of America?
Well, in terms of what we've seen from companies thus far, Johnson & Johnson, Eli Lilly, and Merck have, issued press releases saying, oh, we're doing this incremental capital investment in the United States. None of the ex-US companies have done that yet, although maybe that happens in the future. But the thing with pharma production is they're very, very long lead times to build facilities, and they're also highly regulated. So, you have to have some certainty on how long this tariff picture is going to play out. And then also, you're going to need FDA inspectors to inspect any new facilities that you're building. So in terms of where CapEx goes, that's still just another huge question mark.
And Emily, it's interesting how grim things feel in this industry right now relative to mid-January. I was out at the JP Morgan Healthcare Conference in San Francisco, and one of the big themes was we're going to see all of this M&A, we're going to see this merger activity, some consolidation in the space, all of those tailwinds that were kind of anticipated at the beginning of the Trump administration. It just feels like they've totally gone by the wayside.
Yeah, absolutely. And we were certainly expecting with the change at FTC, we know FTC had taken a pretty draconian view towards pharma consolidation under the Biden administration. All our large cap companies have very healthy balance sheets. We were expecting really significant M&A to pick up in 2025. But I think the uncertainty created not only with tariffs, but also with what's going on with healthcare policy under RFK Jr. at HHS, I think has led all these companies to just really sit tight and see what happens. We actually, given the policy overhang, downgraded pharma to neutral back in January, right after JP Morgan, as we thought this policy uncertainty would be a drag probably until about the summer.
All right. Emily, thanks so much for joining us. Emily Field there from Barclays talking to us about what to expect in the pharma industry. Let's get a quick check on stocks as the S&P, the NASDAQ, and the Russell 2000 continue to fall. We're looking at a 3% drop for the S&P right now, so not nearly as bad as what we saw yesterday, but it does look like if we stay at these levels, we'll close out the week down 6%. For the S&P 500. The Russell 2000 in an official bear market now, off about 25% from the high that it posted in November. This is Open Interest.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets.
Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Lame. 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 Come on, drop a little further. Don't go fucking up, man. Stop it. Ugh. Oh my god, it's fucking pumping. Fuck you. Fuck you. How the fuck is it pumping? Fuck you. The fuck?
Talk about that economic is open interest.
Motherfucker, quit pumping. Fuck you. Fuck you.
Had been offers before to take over Greyhound, but then in the mid of the pandemic, 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years.
The high for my net account value peaked at like 120, and now it's down 65. I should have fucking sold it at 100, bro. Fuck. Chin, cheros a la verga. Pues now I know. Now I know. My cash balance went up though, man. So my original cash balance when I started was $35. Or I put in what I should say, how I should say it is, I put in $20 one day earlier in the week, and I made a bet and I lost $10 on that bet, roundabout. So, and then I put in another 15, and so I had $25 in my account at that point. Lost 10, and then put a little more money in so I could bet again. And pues yeah, man, like
I just fucking made money. So to recap, I started off with 20, lost 10 on my initial bet. It was on SPY. And I won't get into that. It's not important. Second bet I made was on Nike. And I made money on that. I put $20 towards it. I had $5 left in my account. Remember, I had 25 total. And so right now, my net account value is $65.78. So in total, I had put in $35 this week. And I came out with $65. So 161% increase. Man, that's lame. Can't believe the fucker went up, dude. Are you fucking kidding me? Damn, dude. It went from like 52. So the low, what did it open at? 53. Low hit 52. Man, I should have sold it at 52. I would have had 100. So I really lost out like $15, really. Oh, you're going to make 300. Bullshit. No, hombre, no a la verga. Let me look at SPY. What did we do with SPY? Where is it at right now? SPY 522. Look at Apple. Intel. Look at Intel. Look at that. They got some in the money options. I gotta ask ChatGPT some shit. Because they got some puts for the low. Dude, look at that. 0-day puts on the low. What was I at? Let me see. Nike. What is it? Intel. There we go. Intel. Déjame ver qué está pasando con pinche Intel. What the fuck, bro? What are we doing? Open 21. High 22. Low 20. Where's it going? Man, fuck this. I'm going to buy. ¿Cuánto cuestan? $9.10.
on the effect of tariffs on the global auto industry. Mira Pendit, Executive Director, Global Market Strategist at JP Morgan Asset Management, will give us her thoughts on how to navigate this uncertainty and this volatility in the market. Then around 10:40, we're going to have a simulcast with Bloomberg Television. Howard Marks, Oak Tree Capital Management co-chairman. He's going to be speaking with Bloomberg Television anchor Lisa Abramowitz, we'll bring that to you. So lots happening. We're going to have a lot of market guests and a lot of folks talking to us about different angles that different industries are going to be hit by these tariffs. So we'll dig deep into a lot of key industries here. Market Drivers today is brought to you by Commonwealth, joined over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. Let's get a market update right now with Mr. John Tucker.
All right, guys, the Bloomberg Business Flash brought to you by IBKR. Will the U.S. Consumer Sentiment Index exceed 70 in April 2025? At IBKR Forecast Trader, the yes was recently at 29%. Start predicting today at ibkr.com/forecast. The last trading day for this contract is May 13th. As the market melts down, let's bring you golf news. Crossing the Bloomberg, this according to ESPN, the PGA Tour is rejecting the Saudi PIF revised offer to invest $1.5 billion. Risk tilted to the downside, more investment firms raising the recession probability. Taking a look at the NASDAQ 100, you graph it from peak to trough. Today's being the trough, down 19%, over 19%. So that's flirting with bear market. Of course, China imposing a 34% tariff on U.S. goods in retaliation. Job growth exceeding forecasts for the month of March. Non-farm payrolls increasing 228,000 last month, but investors shrugging that off for now. The Bloomberg Mag 7 index down close to 27% from its peak. Right now, among the movers in the S&P 500, the laggards in terms of index points. You have NVIDIA down 5.2%, Apple down 3.2%, Tesla down close to 7% right now. But the tariffs are a game changer for tech. That's according to Dan Ives at Wedbush Securities.
Keep going. It changed the whole tech paradigm from a supply chain and from a growth perspective. And I think that right now is the scary thing. For the long term, of course, I continue to be bullish in terms of these. But look, this is a black swan event, what he single-handedly has done on a self-inflicted way.
The big event could be Fed Chair Powell set to speak later this morning, 11:25 Eastern. That's a speech in Virginia. Oil continues sinking right now. You have NYMEX crude down 8.2%, 61.47 a barrel. And Paul, as you noted earlier, Bloomberg BNEF points out the cost of production is right around $55 a barrel. Right, Alex?
Yep.
Oh, is this Paul knew that?
Well, Paul said it earlier, but I'll attribute it to you. How about that?
There was the Dallas Fed latest survey said that break-evens are definitely around that area. I'm just taking a look right now. Hang on, it's important. About across all regions, anywhere between 61 to 70. So
there you go.
Are right
all right,
there.
We're there. Yep. S&P 500 down 3.3%. The Dow Jones Industrial Average down 1,125 points. The NASDAQ 100 down 610 points. That's a decline of 3.3%. The Russell 2000 down another 4.6%, firmly in a bear market. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
Happy Friday, guys. This was a week for the books. Alex Steele, Paul Sweeney, John Tucker. This is Bloomberg Intelligence Radio. Honestly, you could just sit here for an hour and just do the soups.
Yep.
Like all the superlatives on a weekly and daily and two-day basis are so unreal.
Moving,
I'm getting calls, I'm getting emails, I'm getting texts from friends being like, oh my gosh, how bad is it? Like, it just gives you that perspective of what's sort of out there in the zeitgeist. Let's get a look at some stocks on the move today. We're joined now by Bloomberg's Lisa Mateo. Lisa, you're looking at Apple.
Yeah, we are, because it ended the day down about 9% yesterday. Erased about $311 billion in market value, the worst single day decline since March 16th, 2020. So that was during the pandemic. This morning, shares have been down about 3%. We all know from the story yesterday, the supply chain relies heavily on China, right? New tariffs will reach 34% for China. But the thing is, it's not just China. Apple also relies on other nations that are affected by tariffs, including India, Vietnam, Malaysia, Thailand, Ireland. And then it's not just Apple too. I mean, Dell Technologies, they sank 19% yesterday. Those shares have been down as much as 6% this morning. So it just goes to show you that it's still in the downfall.
Yeah, the SOX index, for example, talking about the semis in particular, on a weekly basis, it's fallen the most. It's fell the most since 2020, lowest levels in November 2023. I think
Chincheros a la verga, güey. Come
for a
on.
little bit.
Let's go.
Also, let's look at Nike. Talk about a stock that got really hurt yesterday. Where are we today?
Yeah, most definitely. But what's wild about this is that during President Trump's first term, apparel footwear makers, right, they shifted their manufacturing out of China to avoid tariffs. And now they're being hit anyway because Trump is targeting the same nations that they decided to move to. So nations like Vietnam facing a tariff of 46%. So Nike, as we know, ended the day off down more than 14% yesterday. This morning, down as much as about 5%. And it wasn't just Nike. We had Adidas, Lululemon too. What I found interesting, though, is that how much is produced here in the U.S. So analysts from Jefferies, they estimate that only 2.5% of the U.S. apparel market and 1% of the footwear market are made domestically. Vietnam actually exported $44 billion in textiles last year, where the U.S. as actually its largest market.
Wow, there's just no getting around this.
No, there's not.
No, those are real solid numbers. And then let's wrap it up here with some of the automakers. They had already been getting hit to
Finally
some
breaking
extent.
below
Then the tariffs went into effect yesterday. What about
Come on.
Stellantis?
Keep going. Keep going, motherfucker.
Yesterday, this morning, off
Keep
as much
fucking
as
going.
5%.
Drop to 20.
They're also dealing
Make
with
it
a few
happen.
other things, kind of this trickle-down effect. So the news came out that about 6,000 workers in Canada's auto sector received temporary layoff notices. That's according to their largest union. The majority of them will work at Stellantis plant in Ontario. That makes Chrysler Dodge vehicles. They're going to pause production for 2 weeks starting on Monday. Then on top of that, Stellantis received a downgrade by Fitch due to tariffs. And now what they're doing is they're trying to spark sales. So we heard a similar story from Ford, but the Wall Street Journal reporting that Stellantis now the one who's got that employee discount program to other car buyers and on most of their new models. So we're talking about being effective today, and it's about the cheap Wrangler SUV, the Ram light duty pickup trucks as well. So they might be getting those. They're trying to just get more people in, to buy the things. So that's why they're giving out those employee discounts to just everyday shoppers.
Right, it's so weird. It's like some weird deflation scenario before prices tick back up. Or I guess the idea is companies are going to eat it.
Correct.
They're going to eat those prices. All right, thanks so much, Lisa. Really appreciate it. For more conversations just like this one, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. Let's stay with autos for just a moment. Craig Trudell is Bloomberg Global Autos editor and joins us now. Craig, at the same time, we also got the news that Tesla's estimates were cut further by an analyst on, quote, unprecedented brand damage. What's the conversation in the zeitgeist on that right now?
I think we're hearing fucked up. When you look at some of the numbers, just yesterday we saw the full figures for Tesla in Germany in the first quarter. For them to have some months in the beginning of this year, they were down more than 70%, and that's in a country where they build vehicles, where you think that they would perhaps have built up some goodwill on the basis of employing quite a lot of people outside of Berlin at the factory, and yet for Musk to sort of intervene in the federal election in February in a way that was highly unpopular, and for the protests looking across the U.S. to also carry over here, where we've seen dealerships get paint tossed on them, cars set on fire. It's really intense, the backlash that we've seen against Musk.
So Craig, I'm trying to get a sense how much introduction and the changeover there of the line. Do you have a sense as to what's the percentage between those two?
It's really difficult. I think we are going to be spending the next probably months, maybe quarters, unpacking what exactly the dynamics are here, because
No, a purple one.
Did
Fuck.
have, sort of self-inflicted disruption that I should point out is not unusual in the auto industry. Even very experienced car makers,
Let's
when they
go.
go
Right
from
that
one
way.
generation of vehicle to
Let's
the
go.
next,
Keep
they
going.
often need to do
Keep
some
going. Break 49. Break 49.
down a bit.
Come on, baby.
Production line.
Daddy needs some fucking money.
At all the factories around the world because they make the Model Y everywhere. And, you know, so that was a substantial disruption for them in the first quarter that we shouldn't sort of lose sight of. I do think that, you know, it can't be a coincidence that in a place like Germany, where you've seen Musk poll so poorly, and you know where he so asserted himself so emphatically, you know, you look at those figures, and even as you've seen some weakness for Tesla,
Barely got out of there. Fuck, who was fucking? Who's there? Who's there?
It's going to take us probably some months, maybe some quarters
Who
to
there,
sort out,
motherfuckers?
you know, just how much sort of lasting damage has been done here, and whether
What the fuck? No.
I have to say, you know, you look at if you do Tesla equity in the DES, you get all the good
Who the
information on
fuck shot
Tesla
me?
right away. You look at a
What
PE
fucking
ratio,
prick
it's still
shot me?
12 times.
Where are you,
PE
you
ratio
fucking
of
prick?
Nvidia, and it's 13.
Dude, what the
It is still incredibly expensive when you look at it from that metric. Hey, Craig, really good perspective. Thank you so very much. Craig Trudell, Bloomberg Global Autos editor, joining us on the overall impact of tariffs, but really brand reputational damage when it comes to Tesla. Wow. This is a week.
Yeah, market's just kind of setting some intraday lows here. So about 2.7%. NASDAQ off 3.9% here. And we're also seeing yields come in dramatically. The 10-year Treasury yield now down to 3.91%.
I want to point out, did you guys see that the VIX almost hit 46?
Yes.
And
we called that out.
You called that out?
Oh, yes.
And I bring that up too because when you have funds like the volatility control funds or CTAs that are trend following, right, they're forced to rebalance when the VIX moves. They have to sell equities and put it in cash. We don't have a choice. So I just feel like the churn is going to be sort of a self-fulfilling prophecy. I wonder how that's going to play out, particularly with us. I point out Mira Pandit, Executive Director of Global Market Strategist at JP Morgan Asset Management. It's her job to figure out what's doing in this market. So we're going to ask her and Herman Chan of Bloomberg Intelligence on the sell-off.
What the fuck? had one fucking kill. Wrecked, bro. I got fucking wrecked. Órale, putos. Man, I'm gonna sell it.
At to see more market stabilization. One was a re-rating in valuations. We've seen some of that, but probably not all of that, especially when we think about the re-rating we need to see in earnings. Some downward revisions we would certainly expect to hear about over the next couple of weeks as earnings season kicks off. And so we probably will see more choppiness around some of those announcements as businesses today are thinking about how to cut back on CapEx and hiring to prepare for a potentially higher tariff environment if things do go through as planned. I would also say we're looking at the economic data. Now, the challenge is similar to the jobs report this morning. Any strong economic data we get over the next month, which reflects a pre-tariff environment, is probably going to be dismissed by the market. So it'll be a period of time before we actually start to see things in the data. And the fourth thing was really around a consolidation of tariff announcements. We certainly had a big bang consolidation the other night, but again, we have yet to see the full extent of retaliation and if, in fact, that results in higher tariffs out of the U.S. And again, on sector, different markets and materials. And in the absence of that, we're still in a wait-and-see mode.
Yeah, and we just got that retaliation from China overnight, for example. I mean, the S&P is down 8.4% in 2 days. What provides the floor at this point?
We are going to hear from Chair Powell shortly. Hopefully we could get some more dovish commentary. But the challenge with relying on a Fed put is the fact that the Fed has to weigh slower growth, which would cause for them to cut rates, against potentially higher inflation from tariffs, potentially inflation expectations moving higher prior to any movement in the actual inflation numbers. So while we do expect cuts this year from the Fed, there is a limit to really how much they can do in the face of inflation that was already stubborn and could get somewhat more stubborn going forward.
How do you think about allocation stocks, bonds these days? What's changed, if anything, for you over the last couple of days?
Yeah, like what's safe at this point?
Exactly.
The solace we feel in markets here is actually, as of yesterday's market close, you did still have 5 out of the 11 sectors in the S&P 500 positive year to date. So defensives have been an area where people have sought shelter. Areas like healthcare, staples, utilities. Certainly areas like utilities are probably going to be fairly insulated from tariffs. But staples not so fast because of global supply chains, because of thinner margins. And what we actually have seen in slower economies is people do pull back on some of the goods that you would think they wouldn't. People actually do pull back on food and essential household items. So we have to be a little bit more careful around staples. But value versus growth, we've seen value outperform growth year to date by double-digit percentage points. International versus U.S., we've not only seen international outperform the U.S. by about 13%, but moreover, in dollar terms, that has really helped as you've seen the dollar weaken. So some of these very unloved areas of the market have actually been protected this year. Duration has worked, although I will caution that per my comments about the Fed and inflation, there are still some two-side risks here to yields, but thus far, certainly having core bonds has protected.
How about gold?
Gold is interestingly faltering a little bit. It's already already run a really long way. I think some degree of gold in portfolios has been a good hedge. And when I think about the supply and demand dynamics, typically we're not gold bugs because they're not providing a whole lot of income or an earnings stream. But you do see a lot of central bank buying. And in an environment where people are being a little bit less cautious about the U.S. as a whole, as a safe haven, whether it's the dollar or treasuries in the longer term, then that does provide an alternative to structurally what has been, a pretty reliable bet when you think about the U.S. But gold actually does provide a little bit of policy diversification potentially.
All right, Mira, thank you so much. We appreciate that. Mira Pendit, Executive Director of Global Market Strategies and Asset Management. Some thoughts on these markets. Again, the sell-off continues pretty hard out there. S&P 500 is off just about 4%. NASDAQ off 4.25%. Programs talk to the analysts at Bloomberg Intelligence and talk a little less about their sectors. Let's do that right now with Herman Chaney. Who owns the regional banks for Bloomberg Intelligence?
I was gonna say it's never good when you see him in studio because it always something is gonna be blowing up in regionals when like you see Herman. Otherwise, when we ignore Herman, it's like everything's fine.
Everything's good. So, how do you view from the bank's perspective a world where it seems like from your perspective, a world where it seems like we're in a trade war?
Well, banks are ultimately a reflection of and when the economic expectations are in flux, then typically there's some pain for the banks, and that's where we are today. While all the bad news has been reflected in the stocks, the fundamental performance is still sort of shaping out. I would say that we're coming up on first quarter results in the next couple weeks, and so we'll get a better picture of guidance changes and performance going forward. But right now, we're still waiting to see where the shoe's going to drop in terms of loan growth, credit quality, etc.
And that's my question, because I understand the big banks getting hit in part because that kind of makes sense. But the regional banks may not have the same kind of exposure, right? The real economy, the hard data, is still fine.
Right.
So were you surprised at the extent to which your sector got hit?
Every time there's worries about the economy, these bank stocks sort of get hit first, and then investors ask questions. So that's where we are today. Prices come down, and there's just a lot of worries about credit quality, the guidance coming down, loan growth, fees coming down, top lines coming down. So there's going to be a lot of revisions going forward if these tariffs do really materialize.
I guess one of the things we're hearing that means I probably don't need growth capital.
Right.
So probably not.
Exactly. And that's actually been happening over the past few years. Given the uncertainty with interest rates first and the regulation provided administration, there was just a lot of demand that was just on the sidelines. And you've seen that reflected in loan growth for the industry. It really hasn't moved a lot over the past couple years. And the expectations heading into this year was that Donald Trump and the administration was really going to unleash more activity from the deregulation. But now the trade stat and just what's happening over the past couple years, everything's
Like any kind of like regional M&A that we've all been expecting for the last couple years. That's not
some news that the Discover capital could be pushed through the DOJ, giving the green light to that. So now we're waiting on the Fed and other bank regulators to weigh in. So that could be a good litmus test going forward, but still, there's a lot of uncertainty.
When you see an economy slow down, from a regional bank, is it credit quality? Is it slow?
Well, it's going to be slowing loan growth, and it's going to be sort of the delinquencies, right? So these 30-day past due metrics, 90-day past due metrics. So those will start to and then there's other early talk about that there's some in bank parlance it's called criticism. And so loans that may not be past due yet, but those are sort of the metrics that we look out for every reporting season.
Which banks in your coverage are pretty well set up?
Yeah, I think the market is telling you some things. We just put out something on MRR looking at the 5-day performance of the KBW index, and it shows the trust banks like Bank of New York Mellon, Northern Trust holding up fairly well. M&T and PNC are the ones in my regional bank coverage that are holding up fairly well. And then there are others, smaller regionals that are fairly.
Can I just bring some breaking news to you?
Yeah, please.
The NASDAQ 100 just entered a bear market down. I know it's just numbers, but
no, it's a bear market. We have.
They're numbers, but they're also headlines.
Yep.
That's that's part of it too.
It's people's IRAs and their 401ks. I mean,
I'm not looking at that. Who's looking at that? Any of you guys look at that?
I'm not looking.
I'm not
it's
looking.
now called the
What is like the type of bank
The banks that have still been dinged during the prior regional bank crisis, probably they'll be in the headlines still. So yeah, banks that have sort of weathered it, but there's always that piece of history that all investors come back to. So banks like Western Alliance were sort of teetering during that time probably get pushed a bit more by investors, but we think that their balance sheet and the deposits are really strong going forward.
All right, Herman, thanks a lot. Really appreciate it. Herman Chan joining us in studio. Always good to get your perspective. Bloomberg Intelligence Senior Analyst for U.S. regional banks. All right, here we go. Right, as John Tucker just said, NASDAQ 100 sent to enter a bear market, falling 20% from its recent peak. You're now looking at the declines about 4% for the S&P and the NASDAQ 100 just on this day alone. John Tucker here with the Bloomberg Business Flash. Give us some more updates here.
Yeah, right now. 1%.
Fuck you! Are you fucking kidding me?
On the February 19th of this year at 22,175.
I was fucking hiding, you fucking fuck every last one of you fucks.
Down another 1,482
Fucker
points.
saw me.
This is a 3.7% drop. The S&P 500 and if you keep the score at home, the S&P 500, the broader index, down over 15% from its peak, so well into correction at least. Enterprise stocks publicly traded 5.5% its days. Into a bear market for that index. Today's jobs report for last month pretty solid, but moving forward, tariffs will impact the job market.
Be hiring right now. Of course, you're going to hear the whole down on adding any extra costs, such as labor, add to tariff costs. The first to pull back on hiring, but eventually, if your tariff-related input costs are going up, you might start to see layoffs.
All right, the laggards in the SPX, NVIDIA, 7%, Apple, down to 10%. Investors looking for a Fed
All right, thanks so much. Right, that's really the question. Like, what is the floor here? And what really comes in better from the White House? So S&P is down by about 4%. Just saying, so New York Stock Exchange,
So
as we
brutal.
all know, there are three circuit breakers. One's at 7%, one's at 13%, one's at 15%. When you get to 7, 8, 13, you're going to shut it down for a minimum of 15 minutes. We're clearly nowhere near that. I think it's worth putting out there. The velocity that we're seeing. Obviously, it's a Friday, and a lot can happen in the next couple of hours, the next couple of days. I guess my question is for Jay Powell, since he can't say anything. Like, is that going to be enough?
Did you see volumes, by the way?
It's
No.
crazy.
100%?
They're like, well,
sign on that piece of data. When you get big selling, big volume, it fades huge volume. Maybe it's a little capitulation.
Right, exactly. Only 41%, excuse me, 41 stocks in the S&P are positive. Declining, so you get So say that, but like that's the maybe that's what we're looking at.
I'm out. All right, I'm
We'll
also
see. I
gonna
mean,
stop the stream.
again,
Fuck this shit.
we'll see some more data coming out next week, economic
Later.
data.